Hey guys, it's Dave. Let's do a real estate roundup. We've had some data come out this week. Today, Lennar reported earnings and the stock went up over 4%. They beat expectations, but the main reason that the stock was up is that they adjusted their forecast for the number of homes they're going to deliver over quarter three, which is the summer months. To over 1,000 more homes than they delivered in quarter two, which is supposed to be the big quarter. That's the spring quarter, April, May, June. That's when a lot of the real estate activity happens. And Lennar is making an adjustment that they're going to even deliver more homes in quarter three than they did in quarter two. That surprised everybody. We're not supposed to have builders making money, beating earnings, and delivering more homes when you have interest rates at 7%. They started the quarter at 7%, kind of went down during quarter two, and then ended the quarter at 7%. So it's a adverse borrowing quarter as far as buyers go, but yet people are still finding a way to get into these homes. The CEO of Lennar was on CNBC, and the last thing he said before they cut away is that we just have an overall shortage of homes. So regardless of what the Fed does, their expectation is housing will still continue to hold on to pricing, and there will still be a demand. Now, we did have the Fed pause interest rates earlier, actually yesterday, I think, and they adjusted their forecast to where none of the members of the committee believe that we're going to be cutting the federal funds rate this entire year. So we may have more hurdles to jump through. We're going to continue to hear this higher for longer, just like inflation was. And now, just like interest rates are going to be higher for longer, because they kind of blew this in the beginning and they're having to stay in it a lot longer as inflation doesn't taper off as much as they wanted to. So let's go to an interesting article from a company called AirDNA. Oh my gosh, that's not working. There it is. Okay, so this is a company called AirDNA, and they analyze data from Airbnb and VRBO used by most hosts for short-term rentals to set pricing, to analyze pricing, to get vacancy rates, and things like that. This is a huge data collector in the short-term rental space, probably the leading data company in short-term rentals. And they came out with a mid-year look, and surprise, the Airbnb bust hasn't happened yet, according to them. And they are making adjustments to their forecast. So they talked about demand being better than anticipated because of economic fundamentals, and they've upped their growth forecast to 10.4% year over year, up from 5%. They almost doubled their forecast for growth for this year because the bust that they thought was coming hasn't happened. Now, that's not completely all good news, because supply is still growing, and they think that the number of listed nights year over year is going to be up 14% over last year. So if you have growth of 10% and you have supply growth of 14%, you're going to have an imbalance. Something's going to have to give there, and that's going to be either in occupancy percentage or it's going to be in the daily average rate. So what they're basically saying is occupancy rate is going to slightly go up, and then the average daily rate is going to only go up about 2.1%, but your revenue per, what do they call that? Revenue per available rental is going to go down. Here it is kind of in chart formation, the forecast that they've got for the number of nights listed going up and the percent of demand going up, occupancy going down. So here's a 59, a 62 in 2001, and then the occupancy rate for the next 2 years going down. That speaks to the saturation of homes, but it doesn't look like this collapse or this bust. It's definitely down. They do think that the average daily rate is actually going to go up. That's just basically kind of an inflationary thing. What they said in this article is that people are prioritizing travel. So, we've got boxed up in 2020 and 2021. And now vacation and traveling and getting out of the house is high on everybody's list of things that they're not going to cut when things get tough. Airbnb is stationed pretty well in that you can kind of go to odd places. You can go, someplace close by and still feel like you're getting away. And they've got obviously a lot of things everywhere. It doesn't have to be a destination place for you to get a short-term rental. So we'll see how that plays out. It's interesting because I've been feeling and hearing that, there's just an oversaturation of supply and a lowering of demand, but it sounds like the demand is not going away. The economy is holding up better than everybody thought. The recession that we've been talking about for a year and a half has not arrived. And so, people have been wrong about this, and we'll see how it continues to play out. On that note, let's take a look at the median sales price in all metro markets. This is the Redfin data center that I look at all the time. And now we're just 1% off of last year for the year over year. Not necessarily the all-time high. We still have some higher comps, if you will, that we're coming up against. But look at this trend for all of spring. Despite what interest rates are doing, we've got a steady growth in the median sale price for all metros. It just hasn't happened the way everybody was talking about. The fear, the uncertainty, the doubt, all of the headlines that talk about the housing crash. Certainly prices came down at the end of last year. Volume has tanked, absolutely, and I'll show you that here in a second. But the pricing is really holding in there. The number of active listings that we have is now at the lowest it's been since we started the pandemic. We're even, I think, a little bit lower than 2019, although Redfin doesn't go back that far. Some of the other MLSs are sending reports out where they're comparing this year to 2019 so that we can kind of take the unicorn years of the pandemic out of the equation and remind everybody that we may just be normalizing here. Housing didn't crash like this in the early 80s when we had high inflation. In fact, the only time it really did is 2008. And we think, that's a once in a 3 generation type of event. But everybody seems to want to come, pointing fingers to 2008 like it's something that's going to happen every 8 to 12 years. It hasn't happened yet. We had some price easing. Everybody wants to talk about Austin and Boise and Phoenix. Let's look at Austin and see that things have normalized. This is back to median sales price here. And we're basically, right on line with 2021. And we're a good, I don't know, I think I did a calculation earlier, 42% ahead of 2020. So yeah, it sucks if you bought at the peak in 2022, but if you look at this as the pandemic as a whole and how things have happened since the pandemic with the money printing and the low interest rates, your house price has crashed up 42% since the pandemic started. That's not too bad. So that kind of puts things in perspective. That's the real estate roundup that we've got. I think we've got a lot of things to get through still. Again, the Fed mentioned that they're not going to really lower any of the federal funds rate for the rest of the year. We'll see what that does to mortgage rates. They're closely connected, but not directly. And we'll just have to wait and see. If you like this content, or if you want me to comment about any specific metro area that you're in, I'd like to know your thoughts on that. Please comment below. Thanks so much for watching, and have a great day.